Fundamentally for it is that the Andhra Pradesh policy, liquor policy, which is likely to be implemented from October onwards. And in UP, when that liquor policy was implemented, the sales went up by 3x for the branded industry. So that is why the street is a little bit excited on the fundamental front. On the consumption front, Samsara is a good gin, which I enjoy. They have minority stake over there.
Samsara is still, I didn't know that. Yeah. Minority stake?
Yeah, that pink gin.
But they don't make it.
Yeah, they have a minority. I think 10 or 20% stake is what they have out there. And they got it at very, very low levels. But the way the sales are going up, I guess if they want more, they'll have to pay more. For now, I'll just be having my 60.
Fully cued in on analytics when it comes to all things Friday.
Midesh, just a quick word on the other one is Edelweiss, which has been going like a rocket. Quickly, yeah, Edelweiss? Okay, I think I'll come back to you, Mitesh. Sorry, apologies. We're getting the first rates from the on the market coming through. So what do we have? I think it's a little lower, it's a little flat sideways, about 30 points, 25, 10, 15. I mean, so yeah, it's down, but not out at all. It's 25,130 is where we're at. You basically don't want the market to slip below Wednesday's low. 25,083 is that number. So let's see. We did not violate that yesterday, and hopefully that is not the case today either. You've got the Bank Nifty, which is down about a third. That's 150 points lower. Sensex is down 100 points, 82,094. Advanced decline is positive, some 3:1. It's too early to maybe make too much of it, but it is positive. IT index is starting with some green. So that's basically what you have on the overall indices. More down than up is what the heat map is telling us. That is the Nifty 50 stocks. So some still yet to open up. But what is trading, you've got more in the red than in the green. So let's take it straight to individual stocks. Surabhi.
Okay, if we talk about the key movers and shakers in the Nifty, things are quiet, 33 points down. Bringing up the lower end is actually all of financials. SBI, ICICI Bank, indeed, they've started off weak. There are also a couple of tech names, which are on the downside of the screen as we kick off the day. Infosys is one of them, HCL Tech. So early trends, some banks and some IT stocks are weak. That's how it is opening out. L&T, Tata Motors, HUL, ITC, these are the other names on the downside of the screen. So a fair amount of the heavyweights packed up at the bottom of the screen. Let's look at what's rising. LTI Mindtree is bucking the trend rather nicely. 2.5% up on that stock. There's a little bit of buying on Bajaj Finance for the time being. TCS is trying to break free from the other, otherwise red IT screen. TCS is actually holding out, as is IndusInd Bank. So basically, you've got mixed trends. Within a trend, there are stocks that are non-conforming. For instance, TCS not falling like the rest of the IT pack, and IndusInd Bank not falling like most of the other big banks. It's even Steven, but 40 points down on the Nifty right now.
Well, that's right, Surabhi. But from the broader markets, plenty of stocks moving around. Indigo Paints, because of that large trade, that stock is down closer around 3% or thereabouts. So that's the one that's losing now 4.5% lower. The Goldman Sachs impact has had a bit of an impact on stocks like Indus Towers as well as Vodafone Idea. They don't believe fundamentally the stock should be at these levels. So both those two stocks, in fact, are lower in trading session. Ola Electric, because the lock-in opens up, so that stock as well is down closer around 2%. Let's talk about a couple of winners then. You have KEC. They're bagged an order worth around 1,400 crores for transmission lines in Saudi Arabia. Street likes it. That stock is flying away as we speak. Ashoka Buildcon, one of their arms, Viva Highways, they monetize land in Pune for close to around 450 crores. The street likes that as well. All in all, it's a flattish start, bit of a negative tinge, but mid-cap index, that's the one that's still holding in the green. Prashant.
No, yeah, absolutely. So hopefully it's going to be, we'll see some action, right? I mean, 40 points, 42 points lower is what you have as far as the indices are concerned. And 170 points lower is what you have on the Sensex. So it's unlikely we'll see a very decisive move today because you just don't know which way the number later tonight is going to pull. So you don't want to really be too aggressive on either on the long side or maybe trying to be cute or trying to sell the market or anything of that sort. So just kind of sort of biding time more than anything else is what you're seeing, not just here, but I think around Asia and the rest of the markets as well. So some more rates are coming up on your screens, and we've got individual names coming up. So for now, we've got about 25,100 on the Nifty. That's a 0.25% cut. The Sensex is down about a 0.25% lower, as well as we said VA Tech Vibhag, their order, and the stock is reacting, along with many other names here as well.
all the stocks that our colleagues were just alerting us about, Vodafone Idea, Indus and Aavas, they're all reacting to these notes, and they've come from Goldman Sachs. Aavas is still retaining the opening pop. In fact, it's picking up some volumes as well. 4% up on Aavas Financiers. GS likes this one. But Indus and Vodafone are the two stocks that Goldman Sachs is not that optimistic on. Negative commentary, and both of them have started the journey on the downside for the morning.
Oh, absolutely. Well, we have Manish Sonthalia now joining us, Chief Investment Officer at MK Investment Managers. Manish, good to have you with us here on the program. It's been a while. Thank you for your time. You've been bullish, straight up bullish about prospects for the market, Manish. Even when we've spoken, when we had a bit of red in the screen, we were going through a bit of a down phase, and it's paid off. But tell us now, Manish, where are things at? And are you as sure about the fact that from here you'll make one will make a lot of money through to the end of the year? I'm not talking about the long term. Long term, of course, is the long term. I'm talking about, say, by the end of 2024. Go on.
So the same story continues, Prashant. It's a buy on dips. There is tremendous amount of flows that is coming into the markets. There is a bit of caution because valuations are not very conducive. Roughly around 25% of the entire market is worthwhile buying from a point of view of valuation. It's a pick and choose market. All of that is stays. But having said that, I think the caution will come around the time when you go through the fourth quarter. After the US elections are done with, you have new stocks coming into the F&O segment. All of that will lead to some sort of a volatility. We are stretched on headline numbers as far as benchmark valuations are concerned. There's no doubt about it. Can it extend even further? It can due to flows, but I think one should tread with caution.
Okay, Manish, hi, morning. So the challenge is that what do you buy at the dip? Because the dip tends to be very, very shallow in this market. For what it's worth, if you get some time correction, that's pretty much what you have to take. So there is some chatter on sector rotation, and sort of some fund managers we speak to are saying that it's time to maybe unload a little bit from defense, railways, and capex, and look elsewhere. Do you subscribe to that view? And if yes, what is the portfolio churn that you would advise right now?
Well, I think the stance is to make the portfolio a little bit more defensive, take some beta off the table. I think financials is one area to hide. There's ample margin of safety out here. There is an IT, there is a farm. These are three sectors, and within that, individual stocks will have their own say. But these are the three sectors to basically go overweight on. And the ones to go underweight or slightly equal weight is basically your capital goods, railways, defense. I mean, they can go through some serious time correction, price correction. And some of the names which are potential inclusions in the F&O, and they are trading at some very lofty valuations. And we know all those names, and all this while, because there were no short selling allowed, you could not short sell, there was no price discovery in these sort of stocks. But right now, when you have these sort of stocks come into the F&O, you could see some serious price damage in some of the names which are trading highly illiquid, first of all that, and secondly, at very elevated valuations. You could somehow make out that these prices are controlled in some way or the other. But now you would have an option to short sell. So these are the areas where you could see some serious price damage, and which will lead to a better price discovery. Otherwise, valuations are full in almost all sectors, but some sectors to hide would be financial, IT, and farm.
All right. Hi, Manish. Good morning. Good to see you. When, those stocks that could potentially come into the Nifty, the list is, I think, Zomato is one of those names. Avenue Supermarts is another one that could potentially come in, and Geo Financial, based on the changes in the F&O. They come into the F&O market first and then to the Nifty. So you'll be a little bit cautious on all these three names?
So I think, fundamentals will definitely play a role. It is basically where the growth is going to come and how much of a growth is going to come. If it is priced way beyond comprehension, then obviously it's a no-brainer. I don't want to take specific names, but specifically Zomato, which we own, I think the street will get surprised on numbers on FY 26, 27, and even 28, so to speak. So I don't think really that, this is one name where you have a case of an overvaluation. This whole quick commerce thing is tripling of dark stores by FY 26. I mean, it's yet to play out. So we are owners of that name. Not that I'm specifically recommending this name to anybody, but we think that, the numbers that are going to come for 26, 27, 28 are going to surprise on the positive side. We remain invested. That's not too much of a damage. But the other two names, I don't want to comment, but suffice it to say, it is more to do with valuations and number.
Got it. All right. Manish, let's talk about another space that's virtually done nothing in the last year or 18 months, the paint space. Asian Paints, Berger, Kansai, all of them were worried that there was a big new entrant that is coming in there. Now it seems like they have a couple of tailwinds because the new entrant has come. The impact is not that much. Crude oil prices have cooled up, which will help them with their gross margins in Q3 as well as in Q4. And there have been price increases. And we just had a large trade when a crore shares of Indigo Paints got picked up in a flash. Your view on the paint segment, do you think it's set to paint it a better picture, say by FY 26 or the second half of FY 25?
So the entire building material space, right from cement, etc., has been going slow ever since the announcement of elections were there. Now that we are through with the elections, you have the new finance bill gets signed and assented by the president. A whole lot of funds getting allocated to the housing sector, road sector, infrastructure. And obviously, if housing gets a fillip due to fund allocation, Awas Yojana and all of that, then the building materials itself will go through an uptake. And added to that, so we're talking about volume growth out here. And three dominant players, now you have a fourth one. Everybody should see a tailwind in terms of the sector. But margins is a fillip that paints would see because of decline in crude oil prices. That will come with a lag. But I think the paint sector is due for some revival, because it has really not done anything, so to speak, fear of competition. But I think most of the negatives are there in the price. Second half of fiscal 25, first half of fiscal 26, the entire building material space, and specifically to your question, even the paint sector is likely to do better.
Okay, so an eye on paints, got that. Manish, we discussed quick commerce. I mean, the market is usually looking at any of the new age businesses or tech-related businesses with a lot of anticipation, right? EV is one such thing. We saw what happened with the Ola electric IPO yesterday. And Ease My Trip said that they'll make EV buses, the stock shot through the roof. So just give us your sense on this whole EV thing, the way the market's interpreting it, because Ola then corrected also quite a bit after doubling from the IPO level. So what do you think of EV? And then on the other side is the whole semiconductor play, where companies like Keynes and CG Power, they're setting up these semiconductor units. So from just purely from a stock and investing standpoint, do they still make sense for you?
I mean, the entire EV space and the semicon space, there's a long way to go. We were at conferences throughout the last week, and TSMC was deliberating out here, and other dignitaries from the semicon industry, EV space, etc. But I think the euphoria that is built in both these spaces, are something beyond comprehension. There's a long way to go. Yes, the big macro picture is pretty much okay. But as far as the EV battery is concerned, we are still importing cells and assembling. Really don't have a make in India battery as such just yet. ICE is making a comeback. There's no subsidies that is about to come in the EV space. The environment is quite headwinded, and the valuations at which some of these companies are trading beyond comprehension. Semicon space, again, the outlook remains good from a top-down perspective, but if you zero in on numbers, again, valuations are extremely frothy and euphoric. Just don't, justify the valuations. You alluded to some names, but I would be a total avoidant. Both these spaces.
Okay, so, a word of caution there. And probably worth keeping this in mind. Investors do tend to carry away when you have these big sunrise sectors, right? Before we let you go, this is an important development. Let's pull up Vodafone Idea. The stock is sliding as we speak. It's down 7.5%. Volumes are picking up as well. We want to go back to the Goldman Sachs note. Remember, Rima just alerted us the target that Goldman has put on VI is, if I'm saying it right, 2 rupees 50 paise. That's the target. They're saying it's an out-and-out sell. The reason being that the recent capital raise is incrementally positive, but it is unlikely to be adequate to stop the market share erosion. They're forecasting another 300 basis points market share erosion therefore that call. So it's a big call. They're saying 2 rupees 50 paise on the stock. The stock is sliding. Prashant, maybe you want to come in, and then just a final view on Telecom with Manish as well before we let him go.
I'm just saying that, who won't be happy? Very unhappy, actually. Government of India with that note.
Yeah.
I mean, they put in money. They
Exactly.
put money at 10 rupees.
Yeah.
I mean, I think, and of course, it's of course a view, and we'll see what happens finally. But I think the reason why the stock is also reacting in such a way is because we've not, generally speaking, commentary ever since there was the repair which started to happen, when the promoters put in money and the government, of course, government put in money before that. Generally, the view and from the street has been pretty constructive that, the curative petition is around the corner. And more stuff is going to happen, which incrementally is going to be positive. And then, you get a call like this, which kind of basically says, even with all of this, it's going to be very difficult for Vodafone Idea to, gain share and gain the share of as a profit market share in any meaningful way. I think that is causing a bit of hurt. I don't think it's anything new as well. I mean, whenever we speak with analysts, everyone has pretty much acknowledged that it's going to be hard. It's no one's case that it's going to be easy. It's just that it's coming in from Goldman Sachs and they're putting it out there right now.
Just one more point I wanted to add, because the numbers they've given are so definitive. Maybe that's why the market's really sitting up and taking note. Goldman is saying that Vodafone Idea will have to hike ARPU by 200 to 270 rupees. That's the kind of ARPU increase that will be required if this company is to remain free cash flow neutral. So clearly, I mean, that sounds near impossible to have that kind of an ARPU increase. And those are the concerns that are playing out on the stock. Remember, there was this curative plea as well that was going to go to perhaps resolve some of the pending dues, but we haven't heard the final word on that from the Supreme Court as yet. Anyway, we've gone on for a good bit, so let's take final thoughts with Manish as well. Manish, Telecom, I don't know your views on Vodafone, whether they're as dire, but tell us if you're buying the other incumbents, Jio in the form of Reliance or Bharti.
Yeah, both of them. So we have both of them, but obviously Vodafone is a total avoid. A lot of assumptions built into Vodafone's progress and success, so to speak. First of all, the curative petition, forgiving of the dues due to the government. Then you will have at least 2 rate hikes or tariff hikes that is required for it to come into a sustainably, a black sort of a situation in the P&L. And thirdly, valuation. 10 to 12 times EV to EBITDA 2 years forward is the best that you can give to a telecom company. It's more of a utility. So, I mean, the valuation don't justify anything out there. So, but we own Bharti and Reliance.
Okay.
All right. Manish, thank you very much for joining us. Good speaking with you. Thank you for taking out the time. I just want to make a quick few stock mentions, and then I'll toss it to Nigel. Premier Energy, right? I mean, that's essentially, I don't know if he mentioned it in the morning, but it's up 7% once again. Premier Energy at about 1,074. That's the biggest volume-led gainer once again. So, I mean, it's a listing from earlier this week. And the listing was, I think, from a low of about $800. Now it's moved to almost 1,100 rupees. KEC was not there in the mix, I think. It's up about 3.25%. And Rama Steel, I'm not sure what's happening here. It's a small 15, 16 rupee stock. But look at the volumes today, humongous. Never seen it on the sort of volume leaderboard, but it is there today. There is SBI Card, which is coming up with a 3.5% pop. You had fluorochemicals, Gujarat Fluorochemicals, which was a mover yesterday. It's up 5% this morning. Ashoka Bilcon, I think. Marico is up 4%. So keep an eye out. It's never won. Keep an eye on some of the other FMCG names as well. Marico at about 668. And, Vabag we mentioned, but PG Electroplast is up another 5%. Vibrant screen is what I basically want to say. It's really opened up. It was looking pretty quiet in the broader front as well. But with the 10 minutes, 12 minutes in, the broader market is looking really vibrant. Nigel.
All right. Well, let's focus then on IREDA. The board has approved 4,500 crore fundraise via QIP, FPO, rights issue, preference issue. To talk about this development and more, we're joined by Mr. Pradeep Kumar Das, the CMD at IREDA. Hi, Mr. Das. Good morning and always good to have you on the show. Thanks a lot for joining in. Well, the stock price has come up from around the 310 to around this 240 odd mark. It seems the street wants to get this fundraise out of the way and maybe a potential dilution by the government of India as well. So tell us about both these two aspects. When does the government plan on selling that stake? Is it confirmed that it's going to be around 10%? And what about the fundraise that you're looking at as well? The quantum and what's the tool you're going to be using to raise this money?
Yeah, very good morning to you. And so first of all, there is nothing like government selling the stake, because we need a fair amount of equity, because knowing the kind of business we are in and the sectoral requirement, what it is, keeping in mind the 500 gigawatt. So roughly another 300 gigawatts to be added in the 6 years. So if you see post our IPO, our CRAR went up to 25 plus, and again it has come down to 19. And we need to ensure that healthy CRAR is maintained. So in order to ensure that, and in order to ensure also the sectoral demand requirement for our kind of organization to come forward and support wholeheartedly, so we need fair amount of equity infusion again. So we have requested Government of India to allow us to go for fresh equity so that the fund will be infused to IREDA. It is not that government is going to sell their stake. So when we go for the fresh equity, then natural dilution will happen. So we have requested Government of India to consider that. And we have requested for up to 7%, up to 10%. And Government of India, they are examining. And very soon we will be coming out with the news. And we are hopeful that Government of India is going to allow us. And we have indicated a approximate figure of 4,500 crore requirement by January, February this year. So finally, we'll see what kind of market sentiment, market condition. And it is pertinent to mention that when we went for the IPO and the roadshows and others, the market was not that optimistic about us. And despite our quite good performance and governance quality and all, still market was not that positive. And therefore, the price what we had to finally agree to offer was quite low if you see today context. But at that point of time, that was the fairest of the fair. So the fresh equity, what is going to be infused, that will be adding to our net worth. That will further enable us to go for further borrowing so that we can plan for our disbursement, what we have kept in mind. And we have already submitted a roadmap for becoming Navratna to Maharatna by 2030. So by the time the country reaches 500 gigawatt, by that time, our loan book will be 3.5 lakh crore.
Mr. Das, I have two small quick questions. One is that if you go ahead and all the approvals come in, 4,500 crores of a QIP, this would dilute the government shareholding by how much? Right now it's 75%. So how much would it come down by?
So we have requested up to 10%, and assuming whatever government gives, if they allows 10%, and then our requirement 4,500 roughly we have indicated, by the time we go to the market, we see the market condition, then the percentage will be determined according to that. So we are expecting in the range of 5 to 10 at least will be requiring. So we have requested up to 10. So finally, once government confirms what level they are allowing us, then accordingly, and very soon we'll be getting that information.
Sure. Got it. So roughly you are working with a 5 to 10% range. Let's see what final approvals you get. Again, working with the assumption that the QIP is full 4,500 crores. What is the boost to the CRAR that you will get? Where is that level now? Where will it reach?
Now, whether it will be QIP or OFS, FPO or other modes, that again we will be deciding. We have not finalized that yet. Now, whatever it is, see 4.5 to 5,000 crore if you get, and again our CRAR will be crossing 25.
Okay.
25.
So
Got it.
again, we have to retain any point of time around 17, 18, because we need to ensure that we continue to maintain the stable AAA stable rating by the rating agencies, as well as recently we got from S&P the international rating. So we are now more responsible for that also. So we have to see overall requirement of disbursement or sanction within the company to the sector, as well as keeping in mind that rating and other parameters.
So exactly on the rating, sir, you led us to the next question as well. Now you're rated equivalent to the sovereign, right? As per S&P Global, BBB minus. So that's
generally, if you see what my team gave me the input, that generally the company no company prefers to go to S&P directly when they are going for international rating. But since we have been exhibiting,
I get that, sir. No, so I get that. I just wanted to understand that with the rating being upgraded to BBB minus now, what is the benefit you can get on, say, cost of funds? I mean, what is the decline? What is the benefit that your shareholders can expect now that you're BBB minus as per S&P?
See, when we are given the domestic rating AA plus by one agency and AAA stable by three agencies, still we have to struggle in the market to convince why one agency had given. And finally, once all the domestic agencies to whom we had approached all had given AAA stable, almost 5-7 bips savings we could make it. And if you see our last borrowing, what we did around 1,500 crore, it was at 7.39 rate, and it was almost lesser than 7 to 10 bips what is prevailing in the market. So similarly, once we are having this global rating, see, overseas funding so far we could not explore. If you see March 20 onwards, we have not asserted to overseas funding because our landed cost is becoming costlier. So now with this international rating, we are quite confident. We are certainly going to get further help on reducing our borrowing cost. And fair amount of that reduction we are going to pass on to our sector, and some percentage definitely we are going to retain. So we are working on a win-win model where our investor as well as our borrower both are gaining.
Okay, all right, Mr. Das, give us a few numbers. 4,500 crores via the equity route. Via the debt route, what is the total fund raise you're looking at?
We have planned for this year around 24,000.
24,000. Got it.
Yeah.
And currently, what is your cost of borrowing?
Our latest, what I said, 7.39. Even now we are open, going for another 1,000 to 500 to 1,500 crore. That is already open in the market. So in a couple of days, that will also be finalized.
So 7.4% is what you're borrowing at currently, and this 25,000.
7.39. It was
7.39. Sorry,
almost back.
Got it. Now, this 25,000 crores that you're looking to raise, could you break it up for us? How much of it will be NCD? How much of it would be from bonds? How much of it would be from overseas, as you were mentioning? If you could break it down for us.
Since you touched overseas, I'll respond that first. March 20, our resource composition, 57% was overseas and 43% is domestic. And if you see last June quarter, what result we have published, in that 84% is domestic and 16% only in forex. So we'll resort to now all these green funds, whatever available cheaper sources overseas. We have to see ultimately the landed cost and the tenure, both. And we have to see the ALM mix also. And as far as domestic is concerned, so far all along we have been resorting to banks as well as institutional bonds. And we have requested Government of India for allowing us for 54 EC. We are hopeful we are going to get it soon. And once we get, then fair amount of 54 EC also is going to be in our basket. And apart from that, we'll see the right time, what kind of opportunity available. Our objective is to borrow right time, right amount at a right price.
Sir, that's well said. So you're doing a lot of things. You're hoping that your borrowing mix, which is predominantly domestic, now with this rating upgrade, maybe you can go back and tap the overseas market if it is lucrative. You're saying you're looking at the 54 EC route as well. So all things put together, give us an outlook on the margin. What is the margin expansion that you would like to target this year? Where will exit margins be by the end of FY25?
See, March 22 onwards, the NIM was going down. And if you see last, I think year and a half, our NIM has been improved also. And normally, we do not focus on improvising NIM just like that. because we are in a sector, the moment we enhance the interest rate right, if you see our asset mix, 58% vanilla IRE, where we are having cutthroat competition. There we cannot play with interest rate. But 18% of our book is having emerging IRE, where we can, I can fairly tell you that we can charge any kind of interest the borrower is ready to pay us. But that is not going to serve the purpose of the sector, because the moment we enhance the rate, that the project which is become bankable now, that may not become bankable. And the project which is unstressed now may lead towards a bit kind of stress. So we are very conscious about that. And the 3.5, we are almost getting the NIM, and we are trying to reduce the borrowing cost. And as the time to come, our asset mix is also going to improve, and a fair amount of percentage is going to be there in emerging space, because that is what the developer expects in IREDA.
Sure. So just finally, you're saying 3.5 is the NIM that you'll target this year. And just one more number, sir. What is the AUM growth that you'll target this year? 15, 20%, 10%? Just one number.
The last 4 years, CAGR, if you see, we are having 27% of the loan book. And if you see other parameters, we are be it profit, be it sanction, disbursement, etc., that is our 30 plus CAGR. There is hardly in any kind of NBFC you get where you are getting the growth, and at the same time you are drastically reducing the NPA. So our focus to go on balancing approach. Since we have already given the stock exchange a roadmap by 2030, what kind of loan book would be, all the figures are available in public domain now. And at the end, I can tell you, we are not focusing on simply enhancing the loan book. Our ultimate aim is to maintain the asset quality, ensure that accounts are not getting into NPA zone.
Yes, absolutely. That's a very important sort of parameter as well. We don't want to see the mistakes of the previous cycle made again. So take your point completely. Thank you very much for joining in, and appreciate you making time for us this morning. We'll take a break on that note. Up next on the other side, we'll get chatting with Vinod Agarwal, MD and CEO at VECV, talk about the August sales and, of course, the outlook going forward.
Welcome back. Well, the markets have moved closer to around the 25,000 odd mark, which is an important mark for today's session. 24,950 to around 25,000 important mark. We're at the low point of the day, so we've taken a bit of a nosedive in the last 10 minutes or so. But let's focus on Eicher Motors now. The August auto sales were muted for the company. The total sales witnessed a muted growth on a year-on-year basis. Exports declined on a year-on-year basis and a monthly basis as well. We're talking about the Volvo Eicher, keep in mind. Mr. Vinod Agarwal, the MD and CEO at Volvo Eicher Commercial Vehicle, joins us on the show. Hi, Mr. Agarwal. Good morning. Always good to see you. Well, a bit of a sluggish month is what we are seeing. But how do you see, September and October shape up from here on? And for the year, if you could give us a rough guidance, what kind of a volume growth are you estimating?
Fundamentally, I think the months of July and August both, they have not been so good for the industry. industry as a whole. So if you look at the first industry figures, the month of July, the 3.5 ton and above commercial vehicle industry, the drop has been around 8%. And if you look at again the month of August, the drop was around 9%. So both the months, July and August, the industry had dropped by 8% and 9% respectively. Now this was not expected. So I would first say that the industry is doing lower than the expectations. Now there are various reasons for that, which of course we have been trying to reason it out, that why the industry is behaving like this. One reason is that the monsoons have been protracted and there have been floods in some states, and coal mines are also not fully operational. So therefore, that is one reason. The other is still the capital expenditure which has to happen on the infrastructure projects. That is still that to start in full speed. I would expect that that should start happening soon, and we see a lot of news that a lot of focus is on the spending more and more money from the government side on infrastructure projects. So as of now, there has been slowdown because of this reason, which has made the customers slightly more, you can say, cautious. They are deferring the purchases. So that is one reason because of this, because otherwise fundamentally there is nothing in the environment which should go against the CV industry drop.
So for the year, sir, what should we work with then?
For the year, we are very cautiously optimistic, because I think fundamentals are all in place, because there is demand, there is good movement of goods, because now we are going to see the festive season from October onwards, and then we should see more replacements, because right now the replacements are also little bit held back, and infrastructure projects are not in full stream. Like if you look at the tipper sales, construction truck sales last month drop has been 30%, which has been very high for the industry as a whole. Now the good thing is, even though the industry is dropping, but both the months, July and August, we have grown. In the month of August, if you look at, we have grown by 1%, and in the month of July, we had grown by 12% year on year. So even though both the months the industry had dropped, but we are growing, and as a result of that, our market shares have gone up as compared to the previous year. Like for example, in heavy duty trucks, now our market share is 9.6%, and in light and medium duty trucks, our market share is now 35% plus. So we are very happy about our progress, but I would see that the industry is expected to do better in the balance part of the year, and of course we are looking forward to that.
Yeah, sir, hi, good morning. And the thing is, we've actually reached the second half of the year already, and one is really hoping that come October at least there's a turnaround, because that's the one piece that everyone's holding on to across the industry, right? This is not a Volvo Eicher specific issue. Could you tell us what is the capacity utilization that the plant is operating at right now, with the demand being so anemic?
I think as far as we are concerned, our capacity utilization is all right, even though it is, we would like it to be more. Like for example, if our capacity is both Bhopal and Pithampur put together, if our capacity is around 130,000 per annum, so we are producing around 6,500 to 7,000 per month, which is, you can say we are at 60 to 65% capacity utilization.
60 to 65%. And so one more number, I don't have it immediately, but it will just offer the right perspective. I know every month we talk about sales being sluggish, slight disappointment of 0.1, 0.2% up. But year to date, if you look at April till now, then the year to date aggregate, is that lower? I believe it would be lower compared to the previous comparable period, year on year.
Year on year, industry is still marginally growing. Like if you look 3.5 ton and above, there is a growth of around 1% plus, because we had a good growth in first quarter. There is also some perspective to it, because last year first quarter was very weak, because OBD2 norms were implemented and some of the players were not ready. So last year quarter one was very weak. So on a lower base, this year Q1 there was a good growth. In the industry had grown by almost 10%. However, July and August, both the months drop has been 10% each, approximately.
Okay, that's very helpful. So quick last question, sir. Now that we're talking about the second half pickup, which segment within CV do you think can really spark the enthusiasm again? Will it be buses, tippers, like you're saying, have been very sluggish with the monsoons, etc.? Where do you expect the first push to come in?
I think you have mentioned the right thing. The buses have been the star performer. Buses this year, even though we are seeing the sluggishness in the trucks, the buses, there has been a good growth. YTD growth has been 26%, which is fairly good. And this is on top of last year growth of 30% plus. So buses are continuing to touch new peaks, and we are expecting that the bus demand will continue to be better. And that is the only reason why your overall growth is still 1% plus in the 3.5 ton and above, because of the buses. So balance part of the year, we are seeing good prospects as far as the trucks also are concerned, because there will be good traction in the infrastructure. You will see more capex spending happening from the government side. So we should see more growth coming from the construction trucks, and linked to that, there will be more growth in the haulage trucks as well, because when the construction sector grows, there is more movement of cement and steel also. So that also leads to more growth of the haulage segments. So we would see good growth coming from all the haulage as well as construction. And then, of course, white goods sector, e-commerce, they are continuing to do better. They are, even the first 5 months also, they were better, because there is a good demand of white goods. All the economies are doing better. Rural economies are also doing better. Monsoons are also good. So therefore, we are very, very positive about the balance part of the year.
Yeah, absolutely, because it's not been adding up otherwise, with so much focus on manufacturing. A lot of manufacturing companies doing fairly well, while the CV cycle has not picked up. But thank you very much for the perspective and for joining us this morning, sir. That's Volvo Eicher commercial vehicles. Back to the market. By the way, the market slipped quite a bit. Should just take note of that before we move to our next conversation. The Nifty is down 140 points now, and the Bank Nifty is leading that downturn. But what's different this time is that there's no outperformance from mid-caps. Mid-caps are falling in sync with the large caps for the time being. Prashant.
No, absolutely. You know, we'll talk more markets in a bit, but we also want to discuss something on the policy front, which is important. Now, SEBI proposed amendments to the insider trading regulations, which basically which are aimed at broadening the connected person definition. SEBI has proposed 6 new categories of individuals to be covered under this. The last date for submitting feedback for this was the 18th of August, which is already behind us now. And there's lots of opinion which is coming through. To discuss this and take this forward, we've got Abhishek Dadu, a partner at Khaitan & Company. We also have Sandeep Parekh, managing partner and founder at FinSec Law Advisors. Abhishek and Sandeep, great to have both of you here. Thank you very much for your time. Prashant this side. Sandeep, I mean, and by the way, we've got both of you, and I broadly know that it's going to be interesting because you're not coming from the opposite ends of the spectrum. We want to debate, but there are important differences in where both of you stand. I want to start with you, Sandeep, because you put it out there. Very interesting column that you wrote. And you basically, the title was Proposed Insider Trading Framework Will Criminalize the Innocent. So why don't you start there? Tell us, what does the insider trading rules right now, what does it cover? And what is being proposed? And why do you say it will criminalize the innocent? Go on.
Yeah. So I think broadly, you know, they've created certain relationships which already existed. So immediate relative, for instance, your parents who are dependent on you. If they trade they've created a presumption, as we lawyers call it, that any trades which were, would be presumed to have taken place because of information you have passed on to them. Now, this immediate and dependent relatives keeps that category quite narrow. And therefore, I think it does cause injustice in specific cases, but be that as may, once you expand it to your uncles and aunts and, whole class of people who are just vaguely connected to you, you may not even be getting along with. And in a case which was actually discussed in the Supreme Court, they were actually fighting with them. And they said, no, you guys are kind of connected to each other because you live in the same house. So, this whole deeming provision creates a lot of, innocent people getting caught up, because how do you disprove the fact
that just merely because you stay in the same house or somebody is your uncle, how do you disprove that the person has not passed on information? Unless you have a camera on your head, it's an impossible standard to fulfill. Which means that even if you trade 500 shares in which your uncle seems to have some connection somewhere, and the connection is they've expanded it not just to relatives but to vendors also. So if the person supplying some tires to manufacturing car company, that would also be deemed to be insider. So I mean, it's going to create millions of innocent people who will be presumed to be guilty and who will find it impossible factually to disprove that they're guilty.
No, got it. So Sandeep, right now the insider trading rules cover the spouse, parents, right, and kids.
Kids.
Right. That's
also qualified by they have to be dependent. So if your parents have independent income, then they're not deemed to be.
Okay. So this is the circle, and they have to be dependent on you to qualify and to fall under the. So now what these new regulations are saying, and you say it in your article as well, they're taking relatives as defined under the income tax law. Right? That's essentially what you're saying. So it kind of covers a much larger universe of people who suddenly will fall under these regulations.
Yeah.
Oh, there is no dependency as well.
That's right. So if I'm actually physically fighting with my uncle in a court of law, I'd still be kind of connected to that uncle.
Okay. And you could sort of end up in a mess because of these new regulations, right?
That's right.
Potentially.
And think of it this way, right? It's like I said in the article, it's going to not just have 100% false positives, it will also have 100% false negatives. Because how many people who are really criminally minded are going to trade through their uncles, right? So it's only going to catch the innocents, and it's not going to catch any guilty person.
And I'm assuming that you've sort of sent in your feedback as well, right? I mean, the 18th of August was that last day. Let's get in Abhishek as well, who's looked at this, who's written about the insider trading regulations in the past. Abhishek, you heard Sandeep. I know you've read that article. Your first thoughts, and you've also sent in responses on this matter to SEBI. Where do you stand, and what's the way forward? How should these be evolved? Because we're at that stage now where after looking at all the consultation, etc., SEBI is going to come up with something. Go on.
Thanks, Prashant. So I think what SEBI is really trying to do is cast a wider net. I agree with Sandeep to the extent that maybe they're overreaching here because there are certain parameters, for example, the financial dependence or the consultation to take a trading decision. Those aspects have been done away with. And those are key to differentiate between people who are reliant on connected persons to take a trading decisions. So what is key here is to keep in mind that the earlier regulations had a gap. So for example, if the earlier regulations only covered, for example, your wife and your wife's spouse, it did not cover the spouse's siblings, right? So this really takes it to one level further, which to my mind is logical. But what they also need to do at the same time is to maintain that financial connection or that consultation concept which existed in the earlier regulations. So all in all, what this is trying to do is block a few loopholes, which I think it will be successful in doing. But at the same time, it cannot afford to cast such a wide net where innocent people are also needlessly getting dragged in to insider trading situations.
So you're saying the wider net is good, but just bring in that clause of dependency. And that will do it. Abhishek?
Correct. That's right. Because the idea, so the earlier regulations, so there are two key changes. Earlier, the regulation said that it needs to be an immediate relative, that is one. And along with immediate relative, you had to satisfy two criteria, which were mandatory. The first criteria was that you either had to be financially dependent on the connected person, or you had to consult the connected person to take any trading decisions. This establishes that there is a true connection between these two people, either financially or in terms of consultation. What SEBI's proposed now is they have substituted immediate relative with relative, which is casting a wider net. But at the same time, they've removed those two conditions of being financially dependent and consulting for a trading decision. So to my mind, the first one is fine. because you need a wider net. Immediate relatives just doesn't cut it. You can have one more layer, that's okay. But the second part, where you're removing the financial dependence, that doesn't work. That needs to be retained.
Okay, yeah, that's a very valid point, and I think it was a point well illustrated by Sandeep as well, that you could be, fighting with those relatives on a separate matter for all you know, but just because the financial dependency aspect is not being taken into account, you are connected, and therefore there could be, implications, legal implications there. Sandeep, aside of this issue, is there anything else? Because in June, I believe there was a little bit of watering down as well, and at least from a management perspective, there was this whole concept of coming out with a trading plan, which you can then share with your compliance team, and once they okay it, then you can look at trades. So apart from this issue of family members getting implicated, is there anything else in these regulations which sort of doesn't cut it with you? And also the timelines we're looking at, by when can responses go in, and when is the final outcome expected, or the final regulation expected?
So, I mean, people can send in their comments. Typically, they do take comments after the final date, so that's fine. Anybody wants to send comments, before the board meeting, they will usually consider all the comments that they received. Right? So that's fine. And does it go beyond relatives? Yes. I think they've created a much wider category, including vendors. Like I said, you're supplying tires to a car manufacturer, you consider to be a deemed insider.
But do you think, Sandeep, do you think they will, that is the intent? Or do you think...
So to put it very bluntly, the intent is for the regulator to not do his job, right? So everybody is a criminal, now you come here and disprove it. So it's actually very sad, because no other country in the whole world has this scheming kind of problem.
Let me ask Abhishek on this vendor point, because Sandeep's point is it casts a much wider net. It's not just relatives. Is that how you read it as well?
That's right. I mean, look, the wording is wide, but I'll go on the intent there again. I don't think the idea would be to go after every Tom, Dick, and Harry for no rhyme or reason. There has to be smoke for there to be fire, right? So the idea is you cast a wider net, draft the regulations widely so that you can capture perpetrators, but in that process, there will be innocents which sort of come into the fray, which needs to be avoided. I mean, I'm fully aligned with the thought process that you cannot have regulations where innocents are needlessly getting caught. So that can be fixed in the nuance. But the idea here is not to catch your vendors or such.
Yeah, no, but point taken. But the only thing is, I think as Sandeep is saying, the intent is not there, why put it, right? Make it very clear. Let there be no doubts in that sense. Gentlemen, it's a pleasure. It's an important topic, and we'll come back to this as and when there are more developments. And Sandeep, when you write next, thank you very much for joining us. Abhishek, appreciate you joining us here on CNBC-TV18 as well. Well, let's talk to you about the markets now, which I think are taking a bit of a knock. 200 points now. Does the market know something? We were talking about how perhaps it's going to be quiet, sideways, maybe a little down, but 200? That's about 0.8% cut. Mitesh, your thoughts?
So, Prashant, I was talking about this, that, the market will go into consolidation, give up some gains because the 2-hour and the 3-hour charts are slightly turning negative. I think that movement has started to play out. The one level which I'm watching very closely is 24,850 on the spot, which is roughly about still 90 odd points away from here. There was this gap up which happened on the 23rd, between 23rd August and 26th of August, which is Friday and Monday. And that gap is around those levels of 24,850, 870 zone. So I think, that is a very important support area. Also, that is where the 20-day averages come in. So, I think that's the area which I would believe that the Nifty would take some support and then start consolidating. If that breaks, I'll be worried. But for the time being, I'm believing that, that level will hold. And the stock calls that I have, yeah.
Go on, please.
Yeah. So, on the stock side, I have a sell on SBI and a buy on AU Finance, AU Bank. So SBI is a sell with a stop at about 809.5, 810, and look for target around 770 here. And AU Bank, which has been a buy earlier as well, now I think can be bought afresh with a stop at about 687 for targets of 740.
All right, Mitesh, thank you very much for that. We'll take a quick commercial break here. Manisha is going to be here and she'll tell us if there is some pressure in commodities like there is in equities this morning. Stay tuned, that's coming up.
Welcome back. Well, as always, it's time to now get a roundup of the commodity market action at this hour. We have Manisha with us. Manisha, so what's the headline for you today?
Well, I'm looking at the crude oil prices because there's various big movement coming in for that one. And as you guys were pointing earlier, well, yes, there's no place to hide here as well because almost all commodities are trading slightly in the negative. It also has to do with the U.S. non-farm payroll data. It could go either ways. And then the strength in U.S. dollar index also seems to be weighing on. Add to that the fact that all the economic data that we have seen coming in the last week or fortnight has been on the weaker side. The Brent crude oil prices, let's start with that because this has been the newsy bit all of this week, is still trading near 14-month lows. We did see a knee-jerk reaction overnight and the prices did gain 1% after the OPEC and allies talked about postponing their output increases, but that didn't hold for too long and is the reason that we are headed for a 6% weekly decline. Remember, we already have a July and August as a negative and September first week is down by 6% right now. So, well, yes, the pressure just about continues when it comes to energy as a market. Well, if you move on and if you look at the OPEC and allies, well, they did talk about postponing their output cut and that's exactly what the markets will be looking at. This is a table that tells you on where we have come in from the highs of this year. We're almost down $20 from the highs in this year and the pressure just about continues even at this point in time. So 92 to 72 and 87 to 69 tells you that from the highs we're down by $20 in this year at this point in time and expectations that you could go further down. Important would be to see if the OPEC can actually defend that $70 mark for the Brent prices and that's exactly what they seem to be doing right now. So OPEC and allies, the 8 members that is, were expected to increase production by 180,000 barrels per day from the month of October. As of now, the planned productions have been moved on by 2 months. The OPEC also in a statement did say yesterday that there could be a pause further or a reversal if the markets so need it like that. So that in turn should have been supportive, but not really. The markets also are looking at weaker demand from US and China, and that really is a concern there. And apart from that, it also has to do with the inventories from US itself, which have seen a decline of 6.9 million. That has not supported because the reason being the US imports have been on the lower side is the reason the US firms went down and got these inventories from the major reserves there. The US gasoline inventories in the meanwhile have gained up by 0.8 million. The prices in the meanwhile are lowest since Feb 2021. So the US demand itself shows a decline there. The inventories are down, yes, but the demand itself also is at around 2-year lows. And then comes China, where you are looking at all data on the weaker side. The PMI numbers, manufacturing, services has been weaker. The overall Chinese oil demand growth is down by 2% in this year until now, which is the slowest pace that you have seen in 15 years. The July oil demand numbers were down by 8%, and this is a 2009 low as well. And if you look at the kind of decline that we have seen in China, this is the lowest perhaps since 1929 is what the charts would suggest. So weaker demand from US and China continue to weigh. The China EV penetration, by the way, has crossed 50%. So that's another reason that the Chinese demand has been weaker. The Libya production has come back into the markets as well. The non-OPEC production has been increasing. So everywhere that you look, the supplies are increasing, the demand is not. And as I said, US non-farm payroll data is the thing to watch out for today.
Oh, absolutely. It is. I don't know what our markets are sensing. Maybe they have some whisper number. That's on a lighter note. But a big sell-off on the street underway right now. However, SBI Card has managed to hold out in green. On such a day, it's been one of the top F&O gainers as well this morning. Nimesh is tracking the standout brokerage note that seems to be moving the stock. Nimesh, tell us more.
Yes, sir, Veena. So the stock is reacting largely in the back of a Goldman Sachs report. So today they've upgraded the stock to a buy from sell. So technically it's a double upgrade, and they've raised the target price to 913 versus 652 earlier. Now they see PPOP and ROA bottoming out, and there will be further visibility in terms of improving. Their upgrade is based on a couple of reasons. First being for specifically for SBI cards, there could be nearing the peak of credit costs. So that's the first reason why Goldman is turned bullish. Improving the cost-to-income ratios because the industry is consolidating. And third, the valuation derating which has happened in the stock in the last couple of years. So from almost 36 times 1 year forward in 22, now it's quoting at close to 24 times on 1 year forward. So even valuation is comfortable. They've raised the EPS estimates by close to 7 to 21% for FY25 and FY26 estimates. And that's largely on back of a couple of reasons. One, improving the cost-income ratios by almost 400 basis points. That's the Goldman expectation. Improvement in the credit cost by nearly from second quarter of this year onwards. So that's going to improve. And third, a pickup in the loan growth as well. So on back of all this, a big upgrade coming in on SBI cards. They've raised the EPS estimates. And of course, the target as well from 652 to 913 now.
All right, Nimesh, thank you very much for that. Well, let's take a quick commercial break here. We're going to come back with our segment. It's the economy. My colleague Lata will get chatting with Vishnu Varathan of Mizou Bank and Mitul Kotecha of Barclays, and they put the focus on the US jobless claims data, which came in earlier, and the monthly jobs report, which is due later tonight. Stay tuned.
Welcome to It's the Economy, an important day for all economies around the world. The US August non-farm payrolls numbers are due today evening. Market estimates are that 161,000 jobs will have been created. That's versus 114,000 in July. And the unemployment rate will slip to 4.2% from 4.3% in July. Remember that 4.3% created mayhem, a double-digit fall in stock indexes almost throughout the world. So we need to understand how bad things can get or how good they can be, given the bounce back in the stock indexes from mid to late August. Joining me to help us understand what we should be prepared for are Vishnu Vardhan, the Managing Director and Chief Economist, Asia ex-Japan at Mizuho Bank, and Mitul Kotecha, Head of FX and Macro Strategy Asia at Barclays. Gentlemen, thank you very much indeed for your time. Let me start with you. Vishnu, what is the in-house expectation? Do you think another 4.3 and once again the SAM rule or SAM rule will be triggered and we could see mayhem?
Yeah, I think the risk for us is if we look past particular job outcomes between now and say March or even up to the early part of Q2 next year, SAM rule will continue to be at risk of being triggered. The question for us then is whether or not markets actually react to it and how they react to it. So there are two parts to it. One is, given that the SAM rule is based on moving averages, so on and so forth, we are already at the threshold where you'll continue to trigger it on and off at least, if not consistently. But the variability comes in terms of how markets react to each time it's triggered, because I think the first time shock is over. Beyond that, it's the complementing data set, whether it is in terms of the actual jobs numbers or weakness in hiring momentum. They'll also look at it in conjunction with things like job openings, quit rates, and all of that. But the risks are tilted to an increasing view that the U.S. jobs market is not as strong as it was earlier thought to be or hoped to be, and B, that sets the stage for markets to oscillate or swing wildly between Goldilocks or Chicken Little, depending on what they're looking for.
Okay. But your fears are to the downside, that there can be a downside risk. Similar question to you, Mitul. What's your US economist view or market view is? Can we be shocked to the downside? Today everything is weak. You look at the oil numbers, $72. Across the globe, Indian markets, absolutely, we never expected a 1% cut across all indexes. So is the market smelling a bad number?
Oh, look, I think you hit the nail on the head. This is a crucial piece of data, not just for the US, but for global markets. And we've all got eyes on it. And our view is 175,000 increase in payrolls, unemployment rate dropping back down to about 4.2%. Now, the market is very skewed towards bad news, as you say. And I think we had the JOLTS data yesterday, which also added some negativity towards the expectations for the payrolls report today. And clearly risks are there that if we do see a jump in the unemployment rate in particular, say maybe by 20 basis points or so, and a payrolls outcome that comes closer to 100K rather than 175 or 169, there is a risk that the Fed would, or is a very good probability if that's the case, the Fed goes by 50 basis points in September. Now, normally you'd think if the Fed is going to cut by 50, that would be great news for markets, but the market is worried about growth. The market is worried about a harder landing in the US economy and what it means for the global economy, global commodities, and global assets in general. And so I think that fear continues to pervade the overall psychology that we're seeing in terms of market trading at the moment. And it's clearly weighed on the US dollar. So the dollar has been under a great degree of pressure in recent weeks and months. And until we get a bit of a clearer picture that the US economy is slowing more gradually, slowing to a softer landing, the Fed only then cuts by 25 this month and 25, in our view, in November and December, that volatility and uncertainties is likely to continue to persist.
Okay. Yeah, I think that is very important to take note of, that if the Fed cut less, that will be good for the market, right, Vishnu? That's how we should interpret it. If they cut 50, then actually it's bad for the market. Am I right?
I think, yeah, mostly that would be the line of reasoning for markets, which is thinking about Is the Fed worried about something? If they are, then we should be as well. So the 50 basis point cut coming from a place where they are patient enough to assess looks like a big leap. And that leap is probably markets are going to suspect that's based on a certain fear factor. And so they all chime in and jump on the fear bandwagon. So you are right that it's a very high likelihood that if it's a 50 basis point and it's not tempered properly with the rhetoric that follows, chances are markets will take it as bad news.
Okay, now let's juxtapose a possibility of 4.3% unemployment, because that's what created the mayhem in July with everyone going off and this newly discovered SAM rule. We will write out what is the SAM rule. We have some graphics on it for people who don't follow that word. But Mitul, if it indeed comes at 4.3, will it be as bad? Because last time it was because of the yen carry unwinding. But today we have a bad number from Japan as well. So, I mean, will the mayhem be so much if it is 4.3 unemployment?
Yeah, look, I think the market, if it's 4.3, I don't think that in itself is enough for the Fed to cut more aggressively by 50 basis points. But, you know, it is still going to suggest perhaps a greater slowing in the jobs market than had been expected. And but part of the reason we're expecting, and I think the market is expecting a drop again in the unemployment rate and payrolls, you know, in this range that we're talking about, RB 175, is because of the belief that the weakness in the last report was very much down to Hurricane Beryl, and that caused some temporary weakness. Now, if that is persisting for another month, then I think people will start fearing that this is not just temporary, that there is a more sustained worsening in the jobs market. I don't think the JOLTS numbers overnight has helped on that sense. So there are clearly some risks here. But look, our view is that you probably need to see at least 20 basis points increase in the unemployment rate. So 4.3 may not be enough. At the same time, you've got to look at the payrolls. If the payrolls do come in, you know, decently, but you get a bit of an increase in the unemployment rate, that may also not be enough for the Fed to be more aggressive in their rate cuts.
Okay, you said hourly wages as well. Sorry, I don't have market expectations of that. What is the number what is the magical number?
Look, I mean, I think for wage growth, the expectation is that generally wages should come in around trend, that we're not going to see any particular weakness in wages here. So, you know, I think overall, the bigger focus is really on the unemployment rate and then payrolls.
Okay, got that. Now, Vishnu, what is the base case Mizuho is going with? And, you know, if it is worst case, then what happens? So what happens in your base case? What is your base case? What happens then? What is your worst case and what happens then?
I mean, so our base case is still for a 25 basis point cut in September. And that's not purely because we don't expect the job market, you know, to just immediately collapse, but more because it would be quite difficult for the Fed to message a 50 basis point cut without looking like they're panicking. So our base case is the jobs number is probably going to be oscillating anywhere between 4.2 to 4.4% in the next 2 to 3 months. Unemployment, after all, is a slow-moving number. But we do think that in terms of the actual job markets, in terms of the churn, the quit rates, the job openings, you'll continue to see further softness. That's going to lead to markets perhaps, you know, the week after when the FOMC comes through, focusing on the so-called dot plot to see even if they did 1 or 2 cut this in September, looking beyond that particular move, looking at how the Fed changes its course for rate cuts beyond that. That becomes more interesting for us. And I think something for markets to really chew on.
Okay, very quickly, Mitul, what is the range you're looking at for the 10-year? By the end of, say, December 31 this year, where is 10-year, where is dollar index?
Yeah, look, I think in our view, the move in 10-year yields has already come off quite significantly from here. So we would expect yields to edge higher in the months ahead. And, you know, clearly, you know, this sort of downshift that we've seen in yields is overextended in our view. So we wouldn't necessarily go short duration here, but we do think the move is extended. If we start to see the softening rather than hard landing, we could edge back up towards that 4% level on the 10-year yield. I think dollar index, look, dollar index, in our view, may have a little bit more of a risk of downside in the short term. That potentially suggests a move below 100 on the dollar index. But look, I think eventually we would still see dollar index or dollar generally rising into next year. And so we think, again, these moves may currently look unsustainable.
Yeah, actually, Vishnu also has that in one of his reports, that actually there could be a risk of, and the dollar index could actually rise. Vishnu, very quickly, we also see a huge Chinese disinflation. When do you pin the first Reserve Bank rate cut?
Well, I think, in terms of the Chinese disinflation, part of that is that the tragedy is it can't be exported in a big way, whether it's due to geopolitics or or onshore problems. So we're looking at the Reserve Bank rate cut coming through in October, and that may be a little bit off consensus, but I think the conditions are in place.
Okay. No, you know what? There is a consensus growing. Yesterday, the governor made a speech in the FICCI IBA meeting, and I want to invite all our viewers to look at para 17, where in bold he says the balance between inflation and growth is well placed. There is a growing body of people who believe he will shift to neutral from withdrawal of accommodation. But I'm just leaving that on the table. I'm out of time. Discuss more later sometime. Thank you very much, Vishnu and Mitul, for your time. We have to wind up on Bazaar Chartbusters coming up, and a very happy Ganesh Chaturthi to everybody.